Hey everyone, and welcome to today's Explainer. We are unpacking what is shaping up to be a genuinely volatile and frankly, completely fascinating stretch in global markets. Today, we're tracking a massive domino effect, homing right in on the July 29th market rout. We've got a global chip stock sell-off, a major hit to US chip makers, a really tense Federal Reserve decision, and a high-stakes big tech earnings season, all colliding at the exact same time. So buckle up, because the sheer pace of this market movement is nothing short of dramatic.
Now, 20 minutes. That is literally how long the South Korean stock exchange was entirely halted. The Kospi index plunged a staggering 8%, and that triggered a circuit breaker for the second consecutive day. I mean, that's the kind of immediate, drastic market mechanism you only see when sheer panic takes the wheel. Trading just completely stopped.
Part 1. The Asian Tech Earthquake.
Okay, let's dive right into the timeline of this financial thriller, starting at the epicenter in Asia, because as you'll see, what started there definitely didn't stay there. The scale of the earthquake across these tech heavyweights is just staggering. We saw SK Hynix tanking nearly 13%, Samsung Electronics lost over 8%, LG Innotek fell 9%, and Seoul Semiconductor dropped over 6%. And this wasn't just isolated to Korea either. Looking over at Japan, Kioxia slid 10%, and Tokyo Electron fell 8.5%. Seeing this much red across such deeply established global powerhouses, it just screams panic. The selling pressure was absolutely enormous.
And, this perfectly illustrates the paradox of this whole situation. Take SK Hynix, for example. They recently posted record quarterly profit and revenue. I mean, stellar financials, right? Yet simultaneously, their stock slid double digits, down over 10%. This is basically the definition of irrational market behavior. How does a company achieve record-breaking financial performance and instantly get severely punished by the market?
Part 2. The Chinese Breakthrough Catalyst.
Well, when fundamental financial logic completely breaks down, like we just saw with SK Hynix, you really have to ask, what underlying invisible force is causing such a violent reaction across the entire Asian tech sector? The answer reads a little bit like a leaked intelligence briefing. As one market analyst noted, the sell-off deepened after reports of a Chinese breakthrough in chip-making technology. This rumor was the trigger. You combine the shockwave of a potential geopolitical shift in tech supremacy with the ongoing market deleveraging taking place in Korea, and you get a massive softening in sentiment toward global tech stocks. Even if the long-term positive views on the sector are totally intact, in the short term, this rumor was enough to strike a match.
Part 3. Contagion hits U.S. markets.
So this localized Asian earthquake didn't just stay regional. It rapidly morphed into a global contagion. The pre-market bleeding in the U.S. was immediate and severe for the heavyweights. Micron technology shares dropped over 4% before the opening bell even rang. This global semiconductor sell-off dragged down Nvidia by about 1.2%, while Intel and AMD both tumbled more than 3%. The momentum of that Asian sell-off just rolled right into the American morning, keeping up this urgent, punishing rhythm across the board.
And honestly, the gravity of that pre-market damage cannot be overstated. It wasn't just a bad morning for a few individual chip makers. This specific semiconductor rout pushed the entire Nasdaq 100 right to the very brink of a technical correction. The weight of the tech sector is so incredibly massive that when the chip makers sneeze, the entire index catches a serious cold.
Part 4. The Fed and Economic Cooling.
Let's actually slow our pace down for a second to look at the tense macro rhythm here. Because this tech sell-off isn't happening in a vacuum. It's colliding head-on with looming macroeconomic hurdles that are complicating everything. U.S. durable goods orders are showing a sharp divergence right now. Back in May, we saw a massive 4% surge. But for June, just a tiny 0.3% rise, which sharply missed the consensus estimate of 2.1%. And when you dig into the data, you see a total split. Computers and electronics actually rose 3.1%, but transportation equipment completely tumbled, dropping 13.5%. So we have an overall sharp easing of the economy, which is sending some incredibly mixed signals to the market.
Now, what is truly fascinating here is the psychology of the market right now. The Fed began its two-day meeting this week. Widespread expectation is that they'll hold rates unchanged. But amid increasingly hawkish rhetoric from some board members, traders aren't taking any chances. They are actively pricing in a 30% probability of a rate increase rather than a cut. That uncertainty alone caused U.S. Treasuries to totally stall out after 3 straight days of gains.
Part 5. The Big Tech Earnings Test. So, with a stalling macroeconomy and a hawkish Fed, we pivot to the final high-stakes hurdle of the week,
corporate anxiety. The stage is basically set for a massive test of expectations. The market is holding its collective breath for earnings from two of the world's absolute biggest AI spenders this week. Plus, we've got heavyweights like chipmakers KLA, Seagate, and NXP Semiconductors who already began reporting after the close on Monday. The entire market is desperate to see if the massive capital being poured into artificial intelligence is actually yielding the financial returns needed to justify these stock prices. The crucial point here is the staggering contrast in the corporate world right now. On one hand, you have the big tech companies operating with basically blank check AI spending, fueling this massive semiconductor demand. But on the other hand, you have media and tech companies like BuzzFeed who are in total survival mode. BuzzFeed just approved a workforce reduction plan aimed at their international hubs to save $29 to $32 million, which is actually going to cost them up to $8.5 million to execute, mostly in Q3. It's a striking juxtaposition. Hypergrowth spending at the very top, and brutal cost-cutting just a few rungs down.
Which leaves us with this final, overarching question to tie all these falling dominoes together. We've seen Asian circuit breakers, U.S. pre-market bleeding, rumblings of a Chinese chip breakthrough, a hawkish Fed, and totally split corporate spending. So are we simply looking at a temporary tech correction heavily isolated in semiconductors? Or is this July 29th market rout the beginning of a much larger structural reset of the global market? It's a fascinating puzzle, and the upcoming earnings calls are going to be the very next piece. Thank you so much for joining me on this explainer. I hope this helped clear the noise, and I'll see you on the next one.